Welcome to Cherry Bekaert's Private Client Services Podcast, your go-to resource for navigating the complexities of personal finance and taxation. In today's episode, we are joined by Cherry Bekaert's Deb Walker and Choreo's Michael Radford. Deb and Michael, can you introduce yourselves, please?
Hi, my name is Deb Walker. I'm a CPA and have been working for many years. I specialize in compensation and benefits. I've worked with both KPMG and Deloitte, and I've been with Cherry Bekaert for about 10 years now. I also specialize in employment taxes, specifically income tax withholding, the payments employers have to make, and then, of course, have done a number of individual income tax returns in my life. And with that, I'll turn it over to you, Michael.
Thank you, Deb, and hello again, Marci. I'm Michael Radford. I'm a managing director at Choreo Advisors. And of course, our firm was specifically selected by Cherry Bekaert as their preferred wealth partner because of our mutual interest in innovative problem solving for middle market business owners. Essentially, our partnership allows our combined organizations to more effectively solve problems at every stage of life and business. Like Deb, my career has spanned many years, principally practicing as a CPA, just like you, Marci. And I think that common history and culture is what really makes our partnership special. Thanks for having me today.
Great. Thank you both. And I agree, Michael. Okay, so let's get started. Today we are going to dive into the discussion of estimated tax payments and withholding and the tax-related cash flow planning that might go along with that. So I'll get started with our first question. Deb, can you just go over high level the estimated tax and general withholding guidelines that apply to individuals? Are individuals required to make estimated tax payments as they earn throughout the year? Are there certain withholding requirements and that sort of thing?
Yes, so anytime the employer pays wages, there are income taxes that should be withheld, and the employer is required to pay them to the government on a set schedule, and those amounts will be credited to the employee's account at that time. Now, sometimes, even when you have no other income and all of your income is subject to income tax withholding, you still have to make estimated tax payment. That happens most frequently when you have a two-earner family, and then by the time you add both incomes together for a married filing jointly return, the withholding is not sufficient. So just because you don't have any other income, you still need to be careful that you do pay your estimated taxes. Another alternative, of course, is to increase withholding in that situation. But I think most people I know like to pay their money to the government at the latest possible time, in which case that's going to be make estimated tax payments in April, June, September, and January instead of increasing withholding. Now, how much do those estimated tax payments have to be? Well, they can be 90% of your current year's taxes divided by 4, because we're going to make 4 estimated tax payments, so it's 25% of that amount. Or it can be 100% of the prior year taxes. And unfortunately, if you have adjusted gross income in excess of $150,000, then you need to pay in 110% of your prior year taxes. That's what we in the business call a safe estimate. So most people don't worry about how much they're making throughout the year, interest, dividends, capital gains, any of that stuff. They just tell their preparer, just give me a safe estimate, which is going to be 110% of your prior year taxes. Now, if you know for sure your current year is going to be less than your prior year, then maybe you want to pay attention and make make payments only on 90% of your current year. So the payment you have to make, I think I mentioned, is 25% of the total, unless, of course, you're using the annualized income exception. And a lot of people use annualized income exceptions when they have a large capital gain. So let's say you sell your beach house in August, then you're not going to want to make estimated tax payments in April and June for an activity that happens in August. So you will use the annualized income exception and determine how much you have to pay in September to take into account the sale of that beach house that had a large capital gain. I think that'll do it.
Okay, great. So I think I heard kind of like 4 sort of options in there. One is if they have withholding, they can use withholding as part of their payments. 2 is they can do sort of like the safe based on 100 or 110% of last year's tax. 3, they can pay in 90% of current year's tax spread between 4 quarters. And the 4th one is they can do what we call as annualizing, which is a lot of times our clients do that whenever they'll have a gain later in the year. And the tax last year was bigger than they want to pay safe on. So that's 4 options, which can be like a little bit confusing in your head, especially if you're not one of us and sit around and think about that all the time. So it also comes with cash flow implications. Michael, with cash flow, I'm going to move that to you.
Yeah, Marci. Since the great financial crisis, Deb mentioned safe harbor, basing your tax on prior year, and that was certainly the easy way out for the last couple decades. But in the current environment, I think it's somewhat of a heads I win, tails you lose environment. You certainly don't want to underpay your taxes, but it's more costly to overpay in the current environment as well. Let me explain that. We all know we can earn a risk-free rate of return today of 5%. After taxes, that's a 3% return on your cash, on risk-free money. The IRS charges us 8% today. So by underpaying your tax, you incur an 8% interest charge. You earned 3%. The net cost to you of being underpaid is 5%. That's a hefty price tag to be underpaid, and something we haven't seen in quite some time. At the same time, if you overpay your estimated tax, the IRS doesn't reciprocate and pay you interest on that underpayment. So you've cost yourself that net after tax 3% that you could earn on your risk-free capital. I think the bottom line, Marci, is you really just need to run the numbers. You can switch back and forth between these methods that Deb discussed. To some degree, you can time transactions to get a capital transaction in the next quarter. And finally, remember, you can always use withholdings to satisfy your estimated payment requirements.
Okay. No, that's an interesting point, Michael. So those of us that work and earn a paycheck know, that we can fill out a new W-4 and maybe adjust our withholding somewhat. But those of us that don't work and are retired also can have withholdings on our IRA account, right, Deb? To their advantage. And then also, if you could also speak to withholding on incentive pay and bonuses and other things like that, and how people might be able to handle that.
Okay, so first of all, let's go to employees, and specifically employees where they can control withholding. To change the amount of withholding, you have to file a W-4 and tell the employer to withhold additional amounts. So many people, especially if they're going to have a bonus in October or November, will withhold a lot of the bonus. And withholding for estimated tax payments is always considered earned throughout the year. So that brings us to the problem that some people have, where they find themselves in December when they go in for their tax planning that they haven't had enough withholding. You can always turn to your IRA and take a distribution from your IRA and elect to have withholding on that distribution. You don't have to have withholding on IRA distributions, but you can have withholding, and you can withhold up to 100%. So what some people do is, if they find themselves in a situation where they don't have enough withholding, they will take a distribution from the IRA. They will have the entire distribution withheld, and then within 60 days, they will roll over an amount equal to that distribution, so that they're sure they don't have to pay tax on the IRA distribution. So anytime you take a distribution from an IRA, you can roll it to another IRA account and avoid tax on it currently, as long as it's not a required minimum distribution, but a distribution that can be rolled over.
Okay. So even people who are not in a situation where they're already retired and are taking required minimum distributions, they could look to their IRA account to get short-term sort of estimated tax payment money.
They could get short-term money for anything. Now, there is a big rule for IRAs. You can only do a rollover once every 12 months. So
Gotcha.
You can't use an IRA sort of as a bank account. Let me get some money and I'll pay it back in 55 days. And, 3 months later, I'll get some more money and pay it back in 55 days. By saying pay it back, I mean pay it into the IRA. But once a year, you can do that. So yes,
Okay.
An IRA is the source of additional withholding, which is useful if your estimated payments in the early part of the year are not as large as they should have been.
Interesting. And so one more time, you said that if I withhold on an IRA distribution I take out on December 15th, that counts as being paid ratably throughout the year.
Yes, that's the rule for withholding.
That's tricky if you don't know. So that's good to kind of have in the back of your mind. I'm going to switch gears just a little bit back to Michael. And Michael, on the note of cash flow planning, I want to get into a little bit of the more complex environment. So we share clients among the three of us in our firm. We share clients that are often have very complex investments and income situations and cash flow situations. So they may have many income sources, unexpected inflows and outflows of cash, and then also the taxability of those cash inflows and outflows can be very almost pretty much unknown to the taxpayer and their tax preparer like me until well after the tax payment's due. A lot of times you don't know if your partnership, for example, is going to have it's going to issue a K-1 showing taxable income on it until maybe June the year after the estimated tax payment was due. So what are the kinds of things that you are doing to help your clients and their tax practitioners understand those cash flow elements related to the taxability of income coming from these complex investments?
Right, Marci, you and I talk about this all the time. Wealth is a magnifier and complexity is no exception there. Whether you have a complex estate plan, a family office structure, or even pacing investments into the private equity space, complexity is a problem. And I think the most important advice is that, broad-based cash flow planning for income taxes has to be an ongoing process. And unfortunately, we don't know all the answers, so it's best to start with worst-case scenarios, working with the information you have available as quickly as possible, and then narrow in on the numbers as the information becomes more, concrete and quantifiable. In today's environment, earning 5% pre-tax is fine if you know that that money ultimately needs to be set aside to pay income taxes. I think it's very difficult to commit capital to equities at this stage of the market cycle if you aren't absolutely sure you have enough money set aside for taxes.
No, that's a great point. And, sometimes it can be sort of paralyzing whenever you get in cash inflow and you're like, well, how much of this do I need to pay for tax? So keeping up with it, I agree, is important. And oftentimes our friends at Choreo will send us over information throughout the year on their clients' cash flows and investments so that we can sort of see the fluctuations and what capital gains may be associated with a private equity payout, for example. So that can be very helpful to have that dialogue that just runs all year long.
Right. No surprises is the best answer. And the earlier you can get started on it, I think the better off you are.
Okay, well, thank you both for your insights today. I wanted to just leave it open to you and see if I didn't touch on something that you think is important. Deb or Michael, do either of you have a topic that you wanted to bring up?
Well, the thing I run into the most is that partners don't actually make estimated tax payments as they should. Many times partners like to be treated as employees. And of course, the IRS does not permit partners to be treated as employees and get W-2s. So there are a lot of structures that you can enter into, tiered structures if the partner really does want to be paid as a W-2 employee and still be a partner. But it is important to activate these, what I'll call workarounds, if a partner doesn't want to make estimated tax payments. In general, I think a partner should just make the estimated tax payments, because it's always better to pay the money in April instead of throughout January, February, and March. And then, so you're making quarterly payments instead of payments with every paycheck. But I know a lot of people like to have those paychecks that are reduced by taxes. So if you are a partner and you want to have regular guaranteed payments, or what you think of as a paycheck or a draw reduced by taxes, we need to make sure, or you need to make sure, that you haven't run afoul of the IRS rule that says you can't be treated as both a partner and an employee by using some kind of tiered structure.
Thank you. That's a good point, and one that I do run into quite a bit. You're right. A partner and cannot be an employee in the same partnership in which he's a partner. Michael, any last thoughts?
And the last thing I would say, Marci, is I think the combined approach, Cherry, Bekaert, and Choreo, again, it's not an exact science, but being able to talk frequently and openly and be on the same page has really helped clients focus in on their cash flow needs for income taxes, and certainly results in a much better answer than trying to go it alone.
I completely agree. And Deb, you made me think of one last thing that is really outside the scope of today's conversation. But that was partnership, partnerships paying tax for their partners. That's a trend that has just exploded. And that's called pass-through entity tax, or PTET. So if you are a partner in a pass-through entity, then you're probably already familiar with that, and the way that can sort of change cash flow needs for the partner versus the partnership. And then also along that same state tax conversation, in the Southeast, a lot of times we have state tax credits that people can buy that can also change the cash flow associated with paying states. So again, state tax payments outside the scope of this conversation is something that any of us would love to talk to you about if you have questions about it. So please follow up with us if you have state tax cash flow questions. And I think that wraps it up for today. I appreciate your time.